Good morning, everyone.
Good morning.
Thank you. Good
Yeah,
morning. Yeah. Thank you all for joining today on Saturday morning. So I welcome you all on this webinar on our newly launched Performing Credit Fund Category 2. So when I say Category 2, out of this, we have three categories in AIF. So Category 2 is the fastest growing category out of all the three categories. It's like if you say the asset under management or what we call commitment, it's already like around 9,13,000 crore. So it's the fastest growing space. So here, like why this performing credit is important in today's scenario. So in this today's scenario, if you see the traditional debt, which gives us around 7 to 8% return, and if you we talk about equity, we can expect higher return, but with the higher volatility. So there is a space between where this performing credit comes, which gives a higher return, around 14 to 15% kind of return with a very moderate risk. So this is a very important category, and a lot of investors they are very much interested in this. So to talk in detail, we have Samir Satyam and Kapil Sachdeva with us. But before that, we have our CEO, Mr. Indabir Jolly, who would just like to have a few words with you. So just to brief you, he has a rich experience of 22 years in a private banking, family office, and partnership distribution and product management. And he has worked with reputed companies like ICICI Security, Reliance Wealth, Aditya Birla Capital, HSBC, ICICI Pru Life. Okay, so over to you, Inder.
yeah. Hi, Pankaj. Thank you so much. Hi, Samir. Hi, Kapil. Very warm
Hi,
welcome to you
hi,
all.
Anil.
A very warm welcome to all our clients. I haven't, we have just joined about 6 to 7 months back as we are focusing very strongly in, scaling up the wealth franchise under the Prabhudas Leeladhar Capital Group umbrella. Thank you, Pankaj, for giving an opportunity to welcome all our clients. So a very warm welcome to our clients. Pankaj also elaborated without taking much of your time, maybe a minute, Pankaj elaborated on this space and why it fits into our clients. So of course, our endeavor is to keep getting more and more solutions, which will balance the asset allocation for our clients, which will ensure that we make the right returns as per our goals, and which also keep in mind tactical opportunities available in the market. Markets are never or no more, just restricted to, of course, our own economy. We are now amongst the top three economies, or very soon we are going to be amongst the top three economies. So obviously, we are very strongly related to the global scenario. Performing credit or private credit as an opportunity, it's about a 35-40,000 crore plus market. Like Pankaj said, category 2 AIF, alternate market is now growing over 20 lakh crore. It's the fastest growing market in the HNI space, in which category 2 is about 50%. Why? There is a reason. It's not just the returns only. The idea is to obviously do asset allocation. Gone are those times when we could just invest into equity and wait for a longer period of time. Market volatility is there not just because of certain economic reasons. There are a lot of geopolitical situations developing. There are a lot of tariff wars happening, and of course, world is now not as stable as it was. So it's important to have a right asset allocation mix and obviously give chance and opportunity to products which balance out the risk but still maintain a decent amount of returns. Because as HNI, ultra HNI investors, obviously our endeavor is not to sustain a 5-6% return. It is obviously to sustain a return which may be on an average of between 10 to 15%. So this fund really fits the bill there. And along with stability in terms of return, it also gives us opportunity to write the Make in India story better. Obviously, a lot of banks have limitations in offering credit to a very good quality companies who need short-term credit for 5 years, 7 years. This product definitely, targets such opportunities, and with professional fund management, generates a better return for the clients, which Samir and Kapil will obviously, explain. We recommend all our clients to look at such opportunities very closely and add it into your asset allocation strategies, because 10%, 11% net of cost, charges, taxes is a significant return, which some of these products, well-managed products, are generating in the last 3 to 4 years and more. So with that, I will invite my colleagues Samir and Kapil to take the discussion forward. Thank you so much.
Thanks, Inder. Thanks a lot, Inder.
Yeah. So, yeah. So as you know, already briefed by Inder and Pankaj, uh, this performing credit Cat 2 is picking up. So we at PL Capital also have successfully launched this product in December 2024. And we have got the SEBI approval. And post that, we are in the market for the fundraise. And we will take you through the five, important parameters on which we have worked over the last 1.5 year when both me and Kapil came on board with PL Capital, and we have built this framework in, and I call it as a 5 Ps. So we will cover that quickly, and then we will keep this session engaging, interactive, and a two-way traffic so that we can answer all your questions effectively. So as you all know, we are part of PL Capital, which is the new avatar of Prabhudas Leather. And we have been, always on the right side of the regulators over the last 80 years, built on trust, integrity, credibility, and all. So, we started as a as a stockbroker in 80 years back, and currently, as we speak, we are a full service provider to any corporate or in ultra HNI relationships we command in the industry. So we are there into array of financial products, starting right from stockbroking, wealth management, investment banking, merchant banking. We have strengthened the team, corporate advisory, institutional research. We are very strong, and now we have forayed into asset management business as well. So under asset management, we have uh, two business line in different entities. One is the quant-based PMS, which is run by Siddharth Vora, Amisha's son, where we have an AUM of 600 to 700 crore. That's a quant-based, PMS. And the second business under asset management is the alternatives, where we are part of, and we have successfully, as I mentioned, launched the first alternative product, which is into Cat 2 space, known as PL Capital Performing Credit Fund. So with this background, I will just take you through, why credit AIFs are in the spotlight and in demand. And if you all have already heard Pankaj and Inder, but just to recap, quickly that this today investors are all flocking towards safer investments with higher ratings, and banks are restricted by RBI for certain end use transactions, and NBFCs have exited the structured lending space, especially post ILFS fiasco, and they are focusing more into retail. And that's where these private credits have boomed in the market, and they are capturing the space vacated by these players. Also, today the family offices have matured, wealth management have become very strong, and we have also got very strong recovery laws like IBC and other lending regulations in the country. AIFs are regulated by SEBI, and if you look at the right side of the spectrum, there's this space of 14 to 18% has been vacated by these players, which are being captured by credit AIFs in the country. Now, in the private credit, again, there are multiple, segment. One is the venture debt, which is the early stage funding, where the deal size is in the range of 20 to 25%. Then there's special situation, which as per SEBI guideline falls under the Cat 1, which captures the stress assets, which is again in the higher than 20% range. and then there's a real estate. So we are in structured credit space, which is in the range of 14 to 18%. So we will be capturing that pocket through our fund as well. Now, the most important aspect is that why investors should look at private credit, and a couple of parameters which I would like to cover and bring your attention to is that it offers higher yield, compares to traditional fixed income products, and also it is having lower volatility, and it provides consistent income return through regular cash flows, and you also get an opportunity to basically enhance your portfolio diversification through asset allocation, and these are mostly deals in private market, bilateral deals, which is not available in the public market, so you can have access to that. And of late, the taxation aspect is very favorable post level playing field, with the debt mutual fund taxation being levied, and now SEBI has very strongly regulated the AIFs in terms of reporting, compliance, fund management, valuation, and even the way entire fund is managed and run. So in view of this, this private credit has also moved up the curve. And just to give you a perspective, the total commitment in the AIF space currently is around 11.5 lakh crore. This keeps on changing. Maybe as we speak, it's 12.5 lakh crore. And as you see, majority of this is in Cat 2. 80% of the commitment is in Cat 2 space. And even in the terms of total number of funds which are launched in the country, Cat 2 again scores over the rest, commanding 58% of the total funds. So we are in the right space, right pocket, as far as the strategy and the positioning is concerned. Now, this is what has been covered briefly, that if you see the Nifty 500 return over the last 5 years, then it's in the range of 16 to 17%. Nifty 50 has given over last 5 years, in around 15-16% return, and bank FD and corporate debts bond are all sub 10 level. So this product, which is performing credit, is giving you a return of 13 to 14%, which is pre-tax IRR in your hand, and hence it's a very good asset class to have in your portfolio to balance out between your equity and the fixed income instrument. Now the PL, at PL, we are all, as I mentioned, we are now having a diversified business. So that's the edge we have, because any private credit or performing credit, you need to have capability to originate the deals, underwrite the deals, then portfolio management, and also control the exits, which is through monetization of assets or liquidity event. This is very important aspect of any credit underwriting. And hence, at PL, we are there in each space. So we have a very strong institutional equity research and research house, where we have got experts in each industry. So that research report and the research house provides us the insight about the business where we are going to lend money. We have got a very strong corporate advisory team, and also the investment banking platform, so that if tomorrow we have to monetize if any of our investee company have to monetize the assets, or go for liquidity event, which is pre-IPO or IPO, we can also help them to do that and achieve that, and in the process we also get our exit. And hence we have, if you see, we have a very strong corporate relationships with 800, corporates across the country. So origination again will be a very, will come in very handy for us. Besides the core team, which have the capability, and we will cover that subsequently. So, so hence, given this background, we are also delighted to share that PL has successfully, launched this product. It's a small fund in the first phase. The first scheme is 500 crore with a green shoe of another 500 crore. So we are targeting 1,000 crore corpus. So what we have done, the first important aspect is PL is sponsoring this fund. So it's not any individual driven fund. PL platform has sponsored it, and PL Capital itself is putting in money, which is around 5% of the total corpus, and this will go up as we go full stack to 1,000 crore fund size. We were good to go with 5 crores, or let's say 2.5%. Effectively it's 5 crores. We were good to go, but we have higher skin in the game, and this money which PL is putting in the fund will always be throughout the tenure of the fund. Second major differential which we have brought in the fund vis-a-vis other funds which are there in the market is the competent team and the governance structure. So before that, I will just take you through the the AIF structure, how it's structured. And if you see the screen, the fund is in the form of trust, and which is approved by SEBI. And we have got the first scheme as PL Capital Performing Credit Fund. Our trustee is Axis Trustee Services Limited, which will have and run, which will ensure that the fund is managed as per the mandate, and will run all the fiduciary responsibility on behalf of the trust. Sponsor is, as I mentioned, PL Capital, which group company, which is PL Alternative Investment Manager Private Limited, which has put in 25 crores in this fund, and this will go up over as we go, further, full stack in the overall corpus. Our investment manager is PL Alternative Investment Manager Private Limited, where the core team, which is myself and Kapil, and the origination, compliance, credit and accounts team all will sit, will be parked here, and the investment manager will advise the fund to invest in portfolio companies, and whatever money comes from the investor, it goes directly into the investee companies, and the returns generated by the investee companies will be upstream to the investors in their hand. We have got custodian, which is Axis Bank, and then the RTA is, fund accounting, RTA, and onboarding is by CAMS. Our legal advisor is IC Legal, and we have got ENY as the tax advisor. So as I mentioned, it's a platform which has launched this fund, and we have got a very important differential delta which we bring on table is that we have got very independent investment committee. I would say, unlike any other fund, we have got seasoned professionals, on the investment committee. We other funds, most funds will have the sponsor or the fund team in the IC. So we have insulated all the critical aspects in business, so that the entire fund is managed effectively and efficiently. So in the investment committee, as you can see, we have got Mr. Rajneesh Kumar. He is the ex-chairman of SBI, and he comes with extensive experience on the corporate credit and project finance side. and he was handling more than 2 lakh crores of assets in the country. So his expertise will definitely be very important and handy to us. Then for structuring the deal, we have got Mr. Avizar Divanji, who was with KPMG and ENY in the financial services and was heading that practice and also the corporate structuring practice with both the marquee, companies in the country. We have got then Mr. Nilesh Vikamse. Again, he's a chartered accountant, and he is also the president of West India Council of Indo-American Chamber of Commerce. He comes with extensive experience on the financial management side and sits on the board of PNB Housing Finance, SBI Card, Federal Bank, and was also the chairman of 360 Degree One Wealth, which is the erstwhile India Infoline Wealth. Then we have got Dr. Punita Kumar Sinha. She is again she comes with extensive experience on the fund management side, runs a big fund from US in the country, and is also on the board of Embassy REIT, Mahindra, and other marquee companies. She is also the chairman of Tata Asset Management Company presently, and earlier she was the MD of Blackstone and was on the board of Infosys and JSW. So Amisha, you all know, she is the founder of PL Capital and comes with extensive experience on the equity and the debt side. And then about myself and Kapil, I will brief you a little bit. As far as I am concerned, I'm having 25 years of experience across liabilities, assets, special situation funding, promoter funding, and alternative investments. Now, in my earlier, assignment, I was with Edelweiss Special Opportunity Fund. I had 2 stints with them. The first stint was in their first fund, which was $230 million. And then when it got fully deployed, I was, heading the corporate structured finance business with Bajaj Finance. And post that, I was also working as business head, structured finance division with Hero FinCorp, and was instrumental in setting up the business right from word go to a 4,000 crore book. And subsequently, when Edelweiss launched their third fund, which was much larger, which is $1 billion fund, again, I was a part of that, managing 1/3 of that in the country. And post that, I am with PL Group for last 2 years and have been working on this product. And I will be managing this fund along with Kapil. And Kapil is the credit head. I will ask Kapil to introduce himself and take it from here. The product aspect and the returns which we are generating in this fund. Over to you, Kapil.
Well, thank you, Samir. I hope so far, in case anybody who so far any queries, please put them on chat. We'll be happy to revert on them, and don't keep it to the last. Probably that for it will go out of sight or out of mind. So all are welcome to put their queries on chat whenever they feel so. Now, as Samir has mentioned, that together myself and Samir would be are looking after the ground investment team. On ground would be there along with our other colleagues. So I come with around 20 years of experience in credit and risk management and structured financing. I have worked with institutions like Axis Bank, Edelweiss Financial Services, TFCI, where I looked after the portfolio of loan book of around ranging from 2,000 crore to 4,000 crore at any point of time. I was primarily responsible for working in the functions of risk management, underwriting, structuring, and portfolio management. I have also spent a considerable amount of time in the rating analytics side, working with Care Ratings and Moody's, wherein I provided fixed income coverage and credit coverage for mid-market and large companies for their debt issues and fixed income issues. I have MBA in finance and also have an executive program in corporate law from IIM Calcutta. So this is in summary for, of our overall professional and educational experience. The team, Samir has already introduced the governance structure which we have put in place for this fund. Samir has already introduced, and this is one of the most unique positioning of our fund, that whatever investment decisions are being made are under the guidance of veterans, financial services veteran who have an impeccable credit record as well as a clean record of their overall career. They all have been, they all have spent around 40 to 45 years in their independent working space, and they come with a very, very strong understanding and knowledge of the market. Now, beyond that, we also have a overlay of advisory board. Now, this advisory board is largely created to provide a best corporate governance and the fund management experience, and also to scale PL Group's, asset management business to next level, always being, fully compliant and being the, and provide the best services to the investor. Apart from Dr. Punita Kumar Sinha, who is the chairperson of our advisory board, which Samir has already given an introduction, we have Mr. Ashok Bharat. He is a fellow of Chartered Accountant and Company Secretary.
Maybe you can be a bit more louder, please. I think.
Okay.
Yeah.
Okay.
Thanks.
Great. Thanks for notifying me. Now there is Mr. Ashok Bharat is there, who is a chartered accountant and company secretary practice. He has been the board member of companies like Bata India, JSW Paints, Everest Industries, and he brings a very, very strong corporate and overall management experience to run a fund business and or to run a AMC business. Then we have Mr. Rajesh Nayan Gupta, who is a legal veteran. He runs a legal firm by the name of SNG and Partners. Has been in this space for around 45 years. So he is again a very, very strong legal hand and with a person of legal acumen. He has been also advisor to various Indian and foreign banks and institutions on corporate banking strategy and the resolution of assets. He has been also the advisor to various regulatory bodies, including SEBI, on various guidelines and otherwise notifications. So this is a kind of a very strong advisory board which we have put up in the board, and these are all long-term. They all align to our long-term vision of creating an asset management company, which serves the investors in the best fashion, which provides the best corporate governance, which provides the best investment management practices. Somebody is telling me that voice is not audible. Is it? Can somebody tell me? There is a message on the chat.
The voice is audible, but it is coming less, so it can definitely get a bit more louder.
Okay, I'll try. Audible, okay. So apart from the infrastructure, both in terms of resources, vendors, and people who are there on the board, which are best in the class, now I'll come down to the key contours of the fund. Now this fund would be a pooled fund, blind pool asset, blind pool strategy, wherein money will be, invited in the form of subscription to the units. We will be allotting units. Like any other mutual fund, you will be subscribing to the units. Units will be, allotted to your demat account, and against those, against the money which you will put in the trust account. Overall fund size is 1,000 crores, which includes 500 crore of green shoe. The fund is a closed-ended fund, which means it has a limited life of 5 years. But again, at the same time, what we are doing is we are following an income distribution model, which means that we will be redistributing or repatriating the whatever
Kapil,
income.
possible to do it without the earphone? Sorry, I'm again telling because modulation voice ki aage piche ho rahi hai bahut. Possible? Otherwise you can continue because sometimes they get thick, sometimes get thin.
Sometimes you get what? Okay.
Voice is really changing up and down.
I just do it to avoid otherwise noise. Just a moment, I'll try. Can you guys hear me?
Oh, super.
Yeah,
Much clearer.
much better.
Okay. Sorry for that previous disturbances. So this is a close-ended fund where we say that it is a limited life of 5 years. For first 24 months, it will be a commitment period where money will be drawn wherever, and after second, third, fourth, and fifth year, money will come back to the investors in the form of principal amortization. But at the same time, there will be regular interest payments right from the first quarter to all the investors, which means for first 2.5 years you will get the interest in hand, and from the last last 2.5 years you will get the principal amount also in your in your hands at a regular basis. So at no point of time you would say that money there is a long-term capital at risk, which will not happen. Investors will get to see the money in their hands right from the first quarter itself. Though there will be non-linear payouts, we cannot guarantee, we do not assure you a linear payout of around, say, let's say 14% right from the first day. It will be a step-up structure always. For first 2 years, annual yield would be in the range of 8 to 10%. And for then third, fourth, and fifth year, the yield will be in double digits. Our fund gross IRR target is around 16 to 18%. As I mentioned, this is a cash flow based coupon. We will also have inbuilt structures wherein we will take the upsides on the equity wherever we feel that this, a deal demands that, or there is a merit in the deal or the investment opportunity. So there is a kind of a sweetener which is available in the form of equity upsides or any kind of a redemption premiums. So which can take our overall fund IRR over and above the 18%. But that will be very, very selective because we will keep that our risk adjusted return to an average of 17% only. Now, what is the flexibility? What is the sweet spot we are providing to the investors? Through this fund, we can invest across the capital structure. We can be senior debt, junior debt, or at par debt, or we can also lend it through a promoter or a mezzanine funding, which means that at promoter level also, we can fund it. Subject to that, we have adequate risk mitigation mechanisms and a desired return from that deal. This fund will be a sector agnostic fund, which means we can invest in all the sectors across the sectors, except real estate, construction finance, which we have kept out of this fund mandate. There are particular reasons to do so, which we will definitely come back as we move ahead. So our largely focus will remain on the manufacturing companies, as well as the services, essential services, education and healthcare. And all our investments at any point of time will be secured against the collateral of 1.5x to 2x. So investor can be rest assured that his principal will remain his principal amount will be protected throughout the tenure of the fund in the range of 1.5x to 2x. We will never do unsecured lending. Now, this security could be in the form of charge on the assets, cash flow of the company, or promoter's personal net worth, including equity and personal guarantee. So this is what we are doing, and we are building a very, very strong, ring-fenced and a risk-mitigated structure to provide this return. But the most critical part is that we are investing in performing credit. This should be the first, hygiene factor which we are looking at. When we say performing credit means we will invest only in those companies which are EBITDA positive or are operating profit generating companies. We will not invest in venture stage companies. We will not invest in distressed companies. So each and every company should have a strong promoter, shareholding, a larger shareholding, consolidated shareholding should be there. There should be not too many layers of shareholding. There should be a legacy of around 10 years with each and every company of a business. And last and foremost, it has to have a EBITDA positive structure. So this is what we are figuring out. This is what we are trying to achieve out of this mandate. So maximum, we will be managing around 8 to 10 companies throughout the tenure of the fund. Not more than our investments will be largely in the form of debentures or optionally convertible debentures. Optionally convertible means where we have the option to convert part of our debt into equity as and when we feel suitable. So these are the kind of structures which we will operate in. Now, all these structures, as I mentioned, will be secured. So from the legal perspective and from the securities law perspective, we are as good as a bank debt. But from the returns perspective and from the risk mitigation perspective, we are as good as the private equity. That's why this product is kind of an alternate or a hybrid product, which provides the investor the capital in the form of which he can use as private equity, but which provide the lender or fund the protection and security as it is in the normal debt. Samir, we can move ahead or probably.
Yeah, sure. Thanks, Kapil. I think then you have covered most of the aspect, and most
We can take
important
the
thing
commercial part.
is about the commercial metrics. And here, as we mentioned, the sponsor commitment is 25 crores, and it's a 5-year fund. We are expecting our first close in 3 months down the line, which will be 200 to 250, 100 crores. Post that, we will start deploying the capital, and the money will be taken in 5 to 6 tranches over a period of 12 to 15 months. Our gross target for the fund is 16 to 18%, which will comprise of the coupon, which will be, let's say, 9 to 11%, and there will be a fixed IRR of 16%. So the differential between the fixed IRR and the coupon of, let's say, 11% will be through step-up coupon or redemption premium. And as and when we get this coupon, we will keep on remitting it back to the investors as a regular cash flow on a quarterly basis. Our hurdle rate is 11% to the investors, and we have very competitive, I would say, management fee, which is starting from 1.75 and for 1 to 5 crores ticket size, and it goes down to 0.75 for a larger ticket size. It's important to note here that we have got nil catch-up, and catch-up is generally on the hurdle rate which we give. In the industry, it's 50% or 100% catch-up. So we are not catching up on that 11%. Only above 11%, we are charging the performance fee, which is carried interest, and that's in the range of 12 to 15%. For a smaller ticket size of 1 to 5 crores, it's 15% to the investment manager and 85% to the investor. So in view of low management fee, nil catch-up, and a lower carried interest, because again in the industry it is 20%, we are charging 15%. In view of all these three aspects, we are able to provide target IRR of 14% pre-tax to the investors in their hand. This will be a tax. This will be a tax pass-through fund, and the tax will be in the hands of the investor as per their tax slab and tax management. So this is broadly about the fund. We would be happy to now take up the questions and answer and address that, so that it's more engaging and meaningful discussion.
Thank you, Samir. Thank you, Kapil, for such an informative presentation. So we have one basic question, like what is the difference between Cat 1, Cat 2, and Cat 3 AIF? If you can just throw light on that.
Okay. So see, as what SEBI has done, SEBI has categorized the funds into 3 different categories. In Cat 1, you have got venture fund, which invest in early stage, social venture fund, which is again more of social impact investing. Then you have infrastructure fund, which is into infra, and it's a longer duration fund. Thereafter you have special situation fund, which is the stress asset funding. So these are all in Cat 1. Cat 3 is basically equity long short fund or any derivative fund which is into equity. Now, anything which is not falling under Cat 1 and Cat 3 comes under Cat 2. And in Cat 2, primarily the funds which are there is a performing credit, which we are part of. Then you have got equity fund and real estate fund. So in the same breath, I would like to highlight that from the PL platform, we are also launching, more funds under the alternative frame platform, which will be again into Cat 2 and Cat 3. In Cat 2, we will have, pre-IPO fund, real estate fund, and sustainability fund. And again, and in Cat 3, we will have, equity long and short fund and other, long fund as well. More importantly, for this Cat 2 fund of ours, this is the first fund with 1,000 crore, and we plan to ramp it up to $1 billion fund over a period of next 4 to 5 years.
Okay. Second thing is that how frequently investor will get the reports?
So the interest, which will be, on a quarterly basis, and then the principal will come from the 4th year onwards. So it's a 5-year fund. We expect investors to be invested for at least, 3.5 to 4 years with us.
So client will get report on the quarterly basis, monthly basis, how it
Okay,
will be?
reporting is on quarterly basis.
Reporting is on quarterly basis, which will cover, all the aspects of where we have invested, what was the rationale for investment, if there's any deviation, what is the remedial measures being taken, and portfolio management and how the exits are planned. And also it will capture the return which is being generated in the fund and the NAVs of the units and other stuff on a quarterly basis.
Okay. And how will be the cash flow payouts? It will be quarterly, monthly, and what is the percentage?
As I mentioned, it will be quarterly, and percentage, it would see, since we will be investing in 10 different investee company, the coupon will be, in the range of 9 to 11%. So average yield you can take, it will be somewhere in the range of 10%, kind of, in the initial years, as Kapil has explained. And then, it will have step up coupon and redemption premium, which is coming in. So overall, at the end of the fund tenor or the investment period, the client will get 14% IRR in their hand.
Okay. So Kapil has mentioned that for this investment is lower for accredited investor. So if you can just throw light on that, who is an accredited investor?
Accredited investors, can invest 50 lakhs. And there are certain, parameters in terms of the net worth, their income, and their financial savvy things. So what we will do, we will share that exact, figures in terms of the net worth, income, and other parameters to be met, so that you can relate to the.
They will have to get us. They do need to get the certification from submit it to the SEBI to get the status of the accredited investor. So there is a kind of a registration certificate which gets. That's a very normal process. People do avail it. Some people don't.
Okay. Yeah. Kapil, there is some question in the Q&A. If you can just take one by one. Yeah.
I can understand that there is a very long list of questions. The difference between Cat 1, 2, and 3 has already been attended to.
Yeah.
So investment strategy and mandate, what is the target return and how it is being achieved through yield, spread, and leverage? That I believe we have already covered, but still, for the sake of small repetition, I can do that. The target return is at gross level. We are targeting 17% return. Now, it is the yield stack up is like in the form of couple of 2 parameters. One would be the regular coupon cash payout, which depends on the positive cash flows of the company. So whatever the positive cash flow of the company can afford to, we will maximize it to use the cash coupon structure. Rest would be in the terms of step up over a later period of fund or in the form of redemption premium. So that's why the yield stack up is like that. In first couple of years, we are providing 8 to 10% annual yield, and for the next later part of the fund or investment period, we are providing a high double digit yield. Another question is, which sector, geographies, or borrower types does the fund focus on? We have already, repeatedly mentioned that what is the kind of a borrower characteristics which we'll be looking upon when investing. It has to be a performing company. That means it has to have a beta positive. The target sector is like mid-size emerging companies, which leaves 500 to 5,000 crore turnover size of the company, which we will be more interested in. Geographies, no bar. Sector, no bar, except real estate and fintech and asset light model, which we have, which we have not included in our mandate. So all asset light models, real estate financing, and as well as the fintech is out of our, but rest, it is a sector agnostic fund. What is the expected yield post expenses to the investors? 14% is the targeted return. What will be the weighted average life or duration of the fund holdings? Not more than 36 months is the weighted average life or duration of the fund holdings. Credit and concentration risk, which talks about maximum single exposure to a single entity would not more than 10% of the corpus. This is how we are managing our portfolio risk and reducing our loss at given default at any point of time. How our credit risk assessed and monitored, internal models, third-party ratings, etc. Now, this is not a model-based rating. This is a very pure play, lending and investment decision which we are making. Though we will be using models or, third-party ratings for our overall decision making, but as a part of information only. We have been into the business for 20, 25 years. A wholesale lending or a large-scale investment decisions, we use such things like ratings and internal models to derive merit in the transaction, but decision making is largely driven by the many qualitative and quantitative factors. So this is just one of the quantitative factor which you're talking about, internal models. Definitely there will be some models and projections which we'll be using based on the overall business sector and the exposure which we are taking on the portfolio. These will be our own proprietary stuff which we'll be using. Third-party ratings, wherever there is a kind of a listed NCD requirement or wherever we have to downsell or do that some kind of a NCD, only then we will rather go for a listed NCD or a third-party ratings. But definitely internal rating models will be used. I have worked with around 7 years with the rating agency, so there is enough of meat and juice which is available with us within the system. We can rate without get the similar kind of ratings. But as I mentioned, wherever it is market determinants are required to get the instrument listed or rated, we will do that. How does the fund manage downgrades, defaults, or restructuring situations? To begin with, we are not entering into restructured accounts as a part of our mandate strategy. Defaults and downgrades, definitely these are some very generic risks which are available, which are there in the lending business. They will remain there as long as the lending will continue. How the fund manages? Now there are two things. I mean, there are a couple of things which every fund can build. There is a kind of a ring fencing or a kind of a structure and a processes which can be developed to minimize the risk of downgrades or defaults. First is in which sector or which risk spectrum which you are entering in. As I mentioned, we are entering into companies which are already there in the system, but we are just capturing on the midterm, arbitrage opportunities of funding. We are not a long-term capital provider. Our average duration maximum will be 36 months, but definitely it will be less than 36 months as well, 2.5 year funding. So we are short-term capital providers. So we are chasing strong balance sheets who can afford our debt. And we are capturing small opportunities, short-term window opportunities where we can chip in with our capital and help the company to tide over with the capital situation or meet its capital needs. So whatever we do, our first line of defense would be the cash flow positive company and a collateral backed company. Our second line of defense would be the promoter's high nuisance value. We will take everything which is available on the board and based on the merit of the transaction, so that we can assure that high promoter skin is there in the game. Third, we will not enter into high risk or high default sectors. As I mentioned, we have kept real estate out of it because that is not our fund mandate to get into a high default, situation. We have kept venture capital out of it so that we can prevent our capital at risk, long-term capital at risk, at loss. So we are building these small measures to keep this thing that downgrades or defaults happen. Even if after that, if something goes bad, we have multiple ways, like any fund. First way is to negotiate with the promoter. That's why we are keeping the security structure tight. That's why we're keeping the promoter skin in the game very tight. If the negotiation fails, then we have a secured structure at the part of securities and companies law. We are there in the company or at the promoter level as a secured creditor. So we have a very high locus standi in the legal ground, in the eyes of the legal ground to recover our money. So we can be there as well. But this is not the part of our game. Wherever we feel that there is a kind of in limited time frame, we cannot get our money back, we will be largely downselling or selling, or probably assigning the loans to a third-party agency at a fair value so that our principal is not at loss. We can be at a loss of 2% loss of IRR due to default, but our principal capital protection structure are there to ensure that there is no capital loss at any point of time. Liquidity and redemption risk. This is a closed-ended fund. We cannot provide any kind of a early redemption through this fund. So you have to live with, our investor has to have a medium-term horizon, investment horizon to stay with us. We also want that to earn a kind of a IRR of 16%, a minimum in a debt instrument and a security instrument. So this much holding period is required. But definitely there are some over-the-counter, mechanisms.
Bilateral deals.
Sorry?
No, I was saying over-the-counter bilateral deals. Go ahead.
Bilateral deals, yes, which are available to provide an emergency exit to any of an investor if required. But these are all on best effort basis. We cannot assure it. But fund that itself does not have any kind of a early redemption mechanism. What will be the liquidity profile of the fund's asset? I'm unable to assess the full question. What is the liquidity profile of the fund's asset? Funds assets means wherever portfolio companies where we are investing in. So liquidity profile can be judged by, I'll give a simple benchmark. Most of the companies where we'll be investing in will lie in the range of BBB rating in terms of, if that can help you to understand what kind of companies which we'll be investing in. Lockup or gates for investor redemptions. I've already attended to that question, I believe so. Fund structure and leverage. Fund is a closed-ended fund. Yes. We don't use leverage. It is not allowed for private credit fund to use leverage other than 15 days short-term working capital, but otherwise leverage is not allowed in these funds. What risk limits or controls are in place? Maximum issuer sector caps. I have already covered that, I believe so. So if who are the key decision makers, investment committee, and what is the track record? Samir has already covered that in our investment committee. As per fund mandate, all investment decisions will be managed or will be approved by the investment committee unless and until independent committee members approve in majority, the investment decisions will not sail through. What are the management and performance fees? Samir has also covered that in our fee. The management fee ranges from 1.75% to 0.75% based on the size of the investment. Performance fee, our 11% is our hurdle rate, and beyond that, performance fee sharing also ranges from 12% to 15%. 15% is the maximum which we are taking, which is highly competitive and comparable. And we would like to incentivize investor at all ends. We are keeping our management fee lower. So whatever we have aligned our interest with the performance fee. So if we make money for the investor only, then we will, as a fund manager, will make profit. Otherwise, we will just meet our expenses through our management fee. How frequently the performance reported to the investors, regular quarterly basis, and as per SEBI valuation reports and other things would be on semi-annual or annual basis. How is capital protection done? Can you elaborate on NPA percent and cost of risk for this fund? As I mentioned, capital protection has many, aspects. Capital protection cannot be just achieved through principal being covered through a hard asset or a security asset. There are many more aspects. What is the duration of the investment? What is the risk premium you are charging? And what is the kind of a deployment structure and amortization structure you are putting in the place? All these comes together in the capital protection. So besides we have talked about only the tangible form of capital protection, which is the security cover, but there are many other qualitative factors in the capital protection, which, as I mentioned, ranges from how you are structuring the transaction and how you are exiting the transaction.
Also, Kapil, just to add in this, we will also not only security and the underwriting, we will have the cash flow trapping mechanism through
Yes, that's what I was mentioning.
account.
How you structure the transaction, cash flow
Yes,
monitoring.
and also the exits for the capital, which is, let's say, a monetization event or liquidity event, will be covered and controlled by us through the PL platform, through our investment banking and corporate advisory platform help as well.
But definitely there are some tangible and intangible methods. As I mentioned, the primary thing is that if you are entering into a positive EBITDA company and you are keeping a cash flow escrow, this is our first and foremost capital protection. Cash is the most liquid asset, and cash is the most foremost litmus test for managing, looking at where the company is going. So we are keeping a track through a separate TRA account mechanism or an escrow mechanism on the cash flow of the company. So that gives a first set of capital protection. Security comes in the last. Collateral comes in the last when all the things fail. So in between that, there are many things. How we are structuring the transaction all gives us a capital protection. But as a matter of fact, we are not entering into their capital protection can be done at two levels. One is at the portfolio level, and one is at the investee company level. At the portfolio level, I have mentioned there are many measures like sectoral exposure, in single company exposure, average yield exposure, sector exposure. All these things are capital protection at a portfolio level. At the investee level, first thing is the cash flow positive and ring fencing of the cash flow. Second thing is the promoter skin by pledging his personal assets or some other net worth aspects of the net worth on the board. We will also go to the extent of getting third-party due diligences. Wherever there is a limited knowledge or a public knowledge available is less about the promoters, which include not only the promoter due diligence, but also about the vendor due diligence. So these are all measures which go towards the capital protection. Now, when you talk about NPA percentage and cost of risk, funds actually does not have an NPA provisioning norm, so nobody reports in the private fund structure as an NPA. So there is no percentage of NPA. But I can tell you about that part that the kind of companies which we're operating in, let's say BBB to A minus, the cumulative default ratio of such companies as per a study by CRISIL is around 3.5% in last 15 years. So that can give you a picture of which set of what kind of a risk set which we are faced to. So this is very, very less, compared to other high riskier or high return asset classes which we are operating in. Considering you are investing in an asset which has only a 3% default rate and give you a return of 16% at a fund level, that proposition makes this product very sweet and investor friendly. Please share a case study if you have any pipeline case. We will do that on selective basis with the individual investor. We can date on no-name basis. Of course, that cannot be done on a webinar, but of course, these things are available otherwise also. You can approach us. Please give some input vis-a-vis competition, how your product has an edge. Definitely, how other products are, like, let's say their overall performing credit space. I mean, as I mentioned, private credit per se, rather than performing credit. Private credit has an AUM of around 1.5 lakh to 2 lakh crore as of now. Within this, around 60 to 65% is, competing in the high stress situations, where large funds like Varde, Oaktree, PAG, these guys are operating. They pick up the special situation or wherever situations is available, in large ticket size, around 1,000 crore total funding borrowing minimum, and special situation where debt or equity is available at discount. So they largely pick up those situations where they buy the debt at discount, wait for the turnaround, and then make good IRR. So right from the very first day, they assure their 20+% return because they buy the debt at 25% discount. So right on the first day, you can say that 20% IRR bana liya unhone. But those are all special situations who have a large balance sheet and who have a large capital, to support too. But over a period of time, a lot of other players have jumped in. this market has extended beyond the special situation or stress funding to a normal day-to-day mid-market line of kind of funding. Over here, we have around in last, let's say, giving you a fact, around 10 billion worth of private credit has been actually taken place. Credit deals have taken place. Out of 10 billion, we can say around 20,000 crore was in the mid-market space where we are targeting. So every year, 20 to 25,000 crore is the consumption from the mid-market and emerging companies where they are not borrowing for the stress situations. They are purely borrowing for the growth, aggressive growth. A growth could be organic and inorganic both ways. They are buying for the pre-IPO stage fundings, where after a 2 years timeline, they are ready for IPO and they want to grow at a fast to bring that company to a scale, and they need money. So they are borrowing for that stage. They are borrowing for cash flow alignment purposes, which is largely refinancing. So this is the space which we are targeting, and there are hardly 30 to 40 players which are available in this space. Because for the rest of them, either the cost economics in terms of returns and size does not match, and they are unable to serve this mid-market segment. So over here, largely domestic players are there. I would say in domestic players also, some people have a kind of a 400 crore, 500 crore of check size ability to do that. So they are also ruled out. People like Edelweiss, Kotak, they are also ruled out in this space. Rest is in sub 100 to 100 plus and 150, there are only 25 to 30 funds, 25 funds, not more than that, who are actually catering to kind of a 100 crore ticket size space. So we will be amongst them. How our product has an edge? Product has an edge can be on two fronts. We have a competitive investor focused fee structure that is purely on the commercial part. Most of the companies are charging 2 to 2.5% of a fee, and beyond that they are charging catch up. Since this is our first one, our focus remains on the immediate delivery and consistent delivery. So we are charging less, but we have aligned our incentives to the profit only. If the investors make profit, if we make profit for the investors, we will take a share of that. The regular fixed income or a fixed compensation is very less. We have a very unique proposition in terms of investment committee and the key investment decision maker, which brings a lot of strong governance in our portfolio. Many of the funds have a limited partner or GP partner driven investment committee. They themselves originate the deal and they themselves take the decision on the investment making. In our case, we might have added a second layer in decision making, which somebody would say it will take more time, you will be less flexible. But we are ready to be less flexible in terms of that, rather than being creating a situation where we make biased decision or make a wrong decision. That's why we have a very, very sophisticated and a marquee investment committee. We might take longer time in decision making compared to another fund who can claim so, but our decisions will be much more consistent. Our delivery will be much more better than the other funds in terms of decision making. So this is our unique positioning in the fund landscape.
So Kapil, what will be the first drawdown? How the investor have to
Sure.
pay? Yeah.
What we are targeting is by mid of next, let's say June end or August for mid, we'll be targeting our first close. First close means that when we declare to the CB that we have raised enough commitment to start the drawdown. So the first, you can target at August 5th, mid of August is our targeted, first close, and then drawdown request will be made to the investors. As of today, investor has to only commit to the capital. Only a commitment letter has to be executed between them. So the drawdown will happen around in 12 to 15 months over a period of, let's say, if we start with August, we will be ending our whole drawdown by next August 26, approximately. The drawdown will happen in multiple tranches, 4 to 5 tranches each of 20%. So if an investor commits 100 rupees, so maximum each drawdown 20 rupees or 25 rupees will be taken on a quarterly basis, and the management fee will also be charged on the drawdown amount only, not on the committed amount. So investors have enough time to plan their cash and the liquidity cycle.
So we have covered. Okay. We have covered all the questions. Yeah. Inder, you just want to say any closing remark, Inder, from your side?
Yeah. Thank you so much, Samir, Kapil. What an extensive, I think, coverage of discussion here, and some really interesting questions. Uh, Thank you everyone for joining us for this. I think we should definitely look at this opportunity to be offered to clients. As an economy, we are growing. Our credit systems are far more cleaner. The evaluation of credit worthiness of companies due to technology development, due to the banking system development, is really grown, become much better. These are very calculated calls, and there is definitely an underlying premium to be earned when you take such calls. Any good quality fixed income, if you have FDs are at 4%, 5% net, they give you liquidity safety, but you cannot bet everything on only liquidity safety. You need assets to make some money also for us. If you go for bad quality papers or low quality papers, then this is again for 8% net. Again, that doesn't make sense. It's not worth the risk. So private credit, performing credit gives you a unique blend of, a calculated risk, but still an opportunity to get, some level of, assured returns. I know I'm using the wrong words, but yeah, they do give, a decent visibility of, returns over 10%. And still, the system is far more cleaner. And as Kapil said, they don't depend only on the collaterals. They start much early on in terms of assessing the cash flow. So there are a lot of due diligence which happens throughout the journey. And then clubbed with a very strong investment committee, which we have. So I think it's a proposition which I will recommend and encourage all our clients to look at very closely. And obviously, if found suitable, give allocation to this. So thank you so much. And Pankaj, great initiative. Thank you so much for giving everybody the opportunity.
Thank you. Thank you, everyone.
Thank you.
Thank you. Thanks a lot. Thanks a lot, everyone, for the
Thanks a
time.
lot.